The US Federal Reserve cuts the Fed funds rate by 25 basis points as expected, with one more set to come next month. But nothing's certain beyond that, with the Fed being cautious as the US economy lands softly. And New Zealand is wary of how Trump's tariffs might affect its beef exports. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at how Trump's tariffs might affect economies in Asia outside of China, starting with the 10% baseline tariff on everyone.
If it leads to slower growth, it is actually going to impact everyone.
But first, in 5 and 5 with ANZ, the US Federal Reserve cut the federal funds rate by 25 basis points to a range of 4.5% to 4.75% on Friday morning Sydney-Melbourne time. US stocks kept rising through the night to fresh record highs, with the S&P 500 briefly rising over 6,000 for the first time and closing up 0.38% at 5,995.54. US Treasury yields were broadly flat. Fed Chair Jerome Powell was cautious in his comments after the cut.
The committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting.
The US dollar index rose 0.5%. The Aussie dollar begins the week down 1.5% at 65.8 US cents as of 4 a.m. Sydney-Melbourne time, while the Kiwi is down 1.66% at 59.67 US cents. Number 2. ANZ's head of G3 Economics, Brian Martin, and senior economist Tom Kenny see the Fed cutting one more time this year, before a relatively slow series of 3 cuts next year to a trough of 3.75%. They see the US economy in a sweet spot and have raised their average US GDP growth forecast this year to 2.8% from 2.6%, and they see average growth next year of 2.3%. It's up from 1.6%. They've also removed one of their forecast cuts for next year from their track, as the US economy experienced the softest of soft landings, although they have yet to forecast the effects of Trump's tariff or immigration promises, given the detail is far from clear. Number 3. One area that may be less affected by any of Trump's tariffs, or may actually boost trade, is China's electric vehicle exports to countries beyond the United States and Europe, which don't have car manufacturers to protect and will be the focus of China's full production at basic prices. Here's ANZ Australia economist Sophia Angala on what's been happening with Australian imports of Chinese electric vehicles.
We're starting to see that the trade flows between China and Australia are appearing to reflect China's investment into electric vehicles. Since August of 2019, Australia's import value of passenger vehicles from China have actually risen over 1,000%, and China's share of vehicle imports to Australia is now at 13%. In comparison, Japan's share of motor vehicle imports to Australia, which is our top source for motor vehicle imports, is 37%. Nearly half of all Chinese manufactured vehicles sold in Australia are electric vehicles, so we're also starting to see the consumers' uptake of electric vehicles here. I'm looking forward as the Chinese economy invests into electric vehicle production and shifts to decarbonisation. This should structurally shift up demand for Australian industrial metals in the future, such as copper and zinc, which since they are used in clean energy technology.
Number 4. New Zealand has plenty of trade at stake with America if Donald Trump follows through on his promise to put a 10% tariff on imports from everywhere. Here's ANZ New Zealand Chief Economist Sharon Zollner.
Probably New Zealand's best hope is that we go under the radar. We're unlikely to be at the top of his list of countries that he has something to gain from in terms of giving us better trade access. But the US has actually passed Australia to become New Zealand's second largest trading partner. It accounts for about 13% of our goods exports. That was nearly $9 billion in the last 12 months, and around a quarter of our services exports at $7.4 billion. So it is a very big market. Meat is number 1. We sell quite a lot of beef for burgers in frozen form. So Americans quite like their burgers, and they probably wouldn't be pleased to to see a price increase there.
Number 5. Sharon says food has often been the first cab off the rank for trade controls and taxes, but there are a few good things happening around for New Zealand on trade.
Food is actually quite a geopolitical item. Food security is quite important to a lot of countries, and they tend to throw up tariffs and non-tariff barriers to protect their own agricultural industries. So, but there have been some wins. New Zealand's just signed a free trade agreement with the Gulf Cooperative Council, for example. So it's not one-way traffic, but I think it is fair to say that it is getting more difficult to get along with everybody, as has been New Zealand's quite successful strategy thus far.
Sharon Zollner there. Now, in our bonus deep dive interview, I asked ANZ's Chief Economist for Southeast Asia and India, Sanjay Mathur, how Trump's tariffs might affect economies in Asia outside of China, starting with the 10% baseline tariff on everyone.
That, I believe, is probably the mildest of the proposals. A 10% tariff really can be absorbed by a reduction in export prices as well as some currency depreciation, and that would probably still hurt exporter margins, but at least it will not necessarily impede the volume of exports.
And however, it looks like Trump has proposed to try to extend the 60% tariff idea on China to some of the nearshoring and friendshoring partners who have developed over the last 8 years or so. So what would an extension to include the friends and the nears, what impact might that have?
That is by far the most severe of the measures. Even if that measure is diluted as we think, so it might not be 60%, but we get to, say, 22%, and then there's a punitive tariff on top of that. But even if you don't get to 60%, the reality is that it would sort of close a very big loophole. So effectively, after Trump 1.0, what is happening was we saw a reorientation of supply chains where the last mile of the production process would be completed in a third economy in the Asia region. Most notably, it's Malaysia and Vietnam, and then it would be shipped to the US. And if you close that loop or make that loop prohibitively expensive, I think it does create new problems for supply chains that have reconfigured over the last 5 years or so. So I think that would be one impact. The second impact is that clearly this kind of restrictiveness also implies that globally demand would weaken, even in the US where the consumer would be hit. And then you get a combo of weak demand plus higher tariffs. And I think that is the most severe implication.
Yeah, so which of the countries in Asia outside of China would be most affected by these more severe tariff and trade controls?
I think that on the top of the list would be Vietnam, followed by Malaysia. That's where we've seen the maximum sort of shift in supply chain into these two economies. By contrast, I would think that Indonesia and India would be the least affected, primarily because they're not very trade-oriented economies at this point in time.
What about Taiwan, which has traditionally had very close relations with both China and the United States in terms of trade? How might it fare in all of this?
Well, I think that Taiwan would obviously also be impacted. But the one thing that stands out about Taiwan and Korea is that they are at the very top end of the semiconductor cycle. And in all likelihood, it would be very difficult for the US to impose severe barriers on them. The whole AI industry, etc., is being driven by chips that are produced in these two economies.
Is there any chance that there could be tit-for-tat tariff barriers erected?
I think there might be a few symbolic tit-for-tat measures, but effectively we have to realize that the US is our biggest or the second largest market for our exports. So picking up or extending this sort of or extending a retaliatory battle is going to be very self-defeating.
Is there anywhere else that they could go to hide? Are there other markets that they could develop or get into?
If you give it 5 years or a bit longer than that, we will see that there would be deeper supply chains. One of the things we've also seen develop, for example, is Malaysia, where you're seeing a lot of US investment come in, that eventually it would come out of this problem. The second is India seems to be very keen to develop deep supply chains or its own supply chain, and I think they would benefit. But what we cannot say for now is that if it leads to slower growth, it is actually going to impact everyone.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, November the 11th. Catch you tomorrow with more analysis of what Trump means for the global economy, and we look ahead to labour force wages figures in Australia and inflation figures out of New Zealand today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.